Chapter 3. The title to Chapter 3 is Concepts of Home Ownership. Back 20 years ago, 30 years ago, that may have been very true with regards to this chapter. Because back then, the entire course was focused in on residential. There wasn't any commercial component brought forth. But in Illinois, do I need a special license to sell commercial real estate? No, I don't. Because we have one license that allows you to sell everything from agricultural to commercial to residential. It's only by your personal choice that you sell residential versus commercial. That's it. So a better way to look at the chapter, it should be concepts of ownership. Excuse me. Concepts of ownership. Now the first element I'm going to show to you is not testable. This is for your knowledge. Now the chapter itself really focuses more on residential, and ultimately that's what we're going to have to deal with. But there will be some commercial elements. It leads off by discussing different types of housing. This itself is not testable. Don't worry about this. But as I'm preparing to get you into this business to be successful, there are two areas of housing that are gaining a lot of popularity amongst investors. And that's because they are, becoming more and more prevalent. First one, retirement centers. The baby boomers are getting old. They're 60s, 70s. They've calculated that the baby boomers will die out within 35 years. But in the course of the next 35 years, these people are going to need certain types of housing. So you got a baby boomer in their late 60s. They're likely empty nesters. The kids are all gone. Why do they need this 4-bedroom home? Let's sell it, move into Del Webb. Get a smaller home that's an active seniors community. You're going to start seeing over the next few years more and more senior centers at all levels. Active seniors, we need assisted living and nursing homes. Because the population that's going to occupy these centers is growing. So investors are going to capitalize on it. Even Inland has gotten involved in developing senior housing. But they deal with active senior housing. The other arena that's gaining a lot of popularity right now, universities. Are they struggling to get money to survive? In fact, there's a commercial on TV right now about Chris Kennedy. And what's the commercial? That as chairman of the board for University of Illinois, he voted to increase tuition rates 5 times. Well, do the universities need to increase tuition in order to continue operations? They may not be getting enough money from the state to do so. So either they're going to cut out programs, cut out services, or increase tuition. It's inevitable. But one of the areas that many of these universities are just plain out cutting out, because they've always been a losing proposition, is student housing. Many universities are discontinuing the maintenance of dorms. And they're going to rely on private housing. So they're selling some of these buildings to investors who are coming in, renovating them, and renting them out like they would an apartment. They're a very profitable method. And that's what you're going to see happening. Northern Illinois. Half the students in Northern live in private housing because it's more cost efficient to the university to let that happen. So the two areas of housing from an investor's point of view that are growing dramatically is in fact student housing, and senior housing. In fact, there's some real estate brokers out there right now that are literally specializing in senior housing. Got a friend of mine out of Naperville. Lisa's whole business is working solely with seniors. And that she will do everything for you. She'll walk in, she'll help you pick a seniors community to move into. She'll help you define which items in your household you're going to get rid of. She'll hold an estate sale for you. She'll call the movers to move you out. She'll bring in the repair crew to improve your home. And then she'll sell it for you. That's becoming more and more of a specialization in the industry. Yeah.
Is that the same as like I think it's called a Scylla I'm not sure. It's my aunt was just telling me about it because she has a house on the south side that she's wanting to turn into a Scylla. She said, "Is that pretty much how?"
I'm not familiar with that, so I can't say.
She said that it's like assisted living, basically. She's saying because she has like a 5-bedroom house, she's able to put 2 people in each room.
Okay.
I guess like I said, for as an assisted living facility. And I just wanted to know what that.
It sounds like it's in that range, yeah. Does that make sense? Okay, let's take a look at the next concept. Page 25. Housing affordability. Now I'm going to spend the next few minutes focused in on residential so you can understand what we're dealing with. If in fact we're looking to buy a home, do I go to the bank to give a mortgage or get a mortgage? I hear get. Everybody agree on get? And that is an incorrect perception. The term mortgage is defined as the use of real property as the collateral for the debt. And it is the buyer that has the access to the real property. Therefore, when you want to borrow money to buy a home, you walk into a lender's office. Mr. Lender, if you give me the money to help me buy this property, I will allow you to put a lien on it. That is the act of giving a mortgage. So in reality, it's not the lender that gives the mortgage, it is the borrower that gives the mortgage. Which is why the borrower is known as the mortgagor. Whenever there's an OR at the end of the word, it's always reflective of a giver. The borrower gives the mortgage. The lender is called the mortgagee. The double E is reflective of receiver. So what's happening? The buyer gives the lender a mortgage, the lender gives the buyer the money, everybody's happy. But all these lenders that we deal with, are they for profit or not for profit? Right. Therefore, if you're coming to me to borrow money, shouldn't I have a sense of comfort that 1, you can qualify for my money, and 2, you can pay me back? Is that what the lender looks at? So when you make application for a loan, the lender's going to look at 3 things. They're going to look at your credit. Your credit score is a reflection of how responsible you have been with regards to paying off your debt. Now, I have a friend of mine who's with MB Financial. And when we get a little bit later into the program, Edna's going to join us. But she's going to give you an understanding of 3 loan packages: FHA, VA, and conventional. And basically what she's going to do is she's going to look at today's economy, today's market. How are these loans being treated by the lenders? What are the minimum requirements necessary for you to secure that loan? Lenders are becoming more flexible. Because of the recession, they had to tighten up tremendously. Now they're becoming more flexible, and they're getting a little bit more creative in how you can actually borrow money to purchase a home. So she'll talk about what the credit scores are. Appraisal. If in fact you buy a home, you've got a contract on a home, you got to borrow money from me to complete the purchase. Wouldn't it be practical on my part to make a presumption that you're going to go into foreclosure at some point in the future? Do I want to protect myself? Therefore, I am going to expect that home to be appraised. See, I'm not going to give you any monies on an overvalued home. It's worth $350,000. You agreed to buy it from the seller for $400,000. Why should I, as the bank, give you money based on an additional $50,000? Not going to happen. In fact, what you want to remember, the loan is always based upon either the purchase price or the sales price, whichever is lower. The loan is always based upon the purchase price or the sales price, whichever is lower.
So it doesn't matter how much they put down as the down payment.
Right.
So it's not, it doesn't matter how much the loan's going to be. Because say if a house is 200,000, you say to put down 50, it's not based on 150, it's based on sale price.
Well, that's what the lender is going to use to base it on, because they're going to give you a percentage of that number. For example, we're talking about $200,000 home. So, Chris, you're going to put up 20%. How much is coming out of your pocket? No.
$40,000.
$40,000. That means the lender is going to have to come up with $160,000 in order for you to purchase the property. Now, if it comes back appraised at $200,000, no problem. But what if it comes back appraised at $190,000? Now the lender is only going to give you 80% of $190,000, not of $200,000. So if you still want to buy that property, you're going to have to come up with an additional $10,000 somewhere to buy it. So the bank's only going to make its decision either on the sales price or on the appraisal price, whichever is lower. Does that make sense? Now we got this last element, income. Do you make enough money to afford the home? Now what we're looking at in terms of income is this kind of configuration. We always use your gross monthly income. Now, gross meaning the income you earn before tax deductions. As an average, what percentage of your income per month goes towards withholdings? 28? Okay. Now, did you include state in that?
33.
I thought it was 28 or 30%.
Well, the good average I use is 30%. So I'm going to put 30% towards withholdings, and I'll just use the word taxes for that. What percentage of your income is left over? 70%. Now, there's two other factors we look at in defining your ability to afford a home. One is called long-term debt, LTD. Long-term debt is any debt you have acquired that will take more than 10 months to pay off. This will include an auto loan, a personal loan. It would include your credit cards. It could include child support. But long-term debt is any debt that will take more than 10 months to pay off. And the other aspect is what I simply use the word live for. That's the portion of your income you can use to put food on the table, put gas in the car, pay the electric bill. Now we've got a 70% of income spread here. This is where qualifying for the loan comes to play. Do I split this in half, 35-35? Do I give you 45% of your income for long-term debt? That's what we want to discuss. Now, before I can get into the specifics of how we judge that, let's clarify what the loan packages consist of that you're going to be using. And let I'm going to draw a line right here. And there's a reason for that. These two loans that are below the line, they are both of them, I should say, are government backed. FHA and VA are government backed. So let's go the opposite. If those are the only two that are backed by the government, that means conventional has no government backing. That means a lender giving you a conventional loan is going to have to assume the full liability on that loan. You owe them $300,000. You go into foreclosure, they can only sell it for $250,000. There's a $50,000 loss there. Can they go to the bank, to the government to get reimbursed? No. They've got to eat the loss. Because a lender on a conventional loan carries a greater level of risk, these loans often tend to be more conservative in nature. Traditionally speaking, on a conventional loan, the lender wants you to put 20% of the purchase price down. That's your personal commitment to that property. And if you put up 20%, what percentage am I expecting to get from the bank? 80. This 80% number is known as the LTV, loan to value. And you're going to use this term even in practice. Loan to value, by definition, is the percent of purchase price provided by the lender. Loan to value, by definition, is the percent of purchase price provided by the lender. So if I'm putting up 40% down payment, what's my LTV going to be? 60%. Does that make sense? Does anybody have any questions? Yeah.
Is conventional, is that part of the primary market or the secondary market?
No, the conventional loan is the loan package you acquire from a primary lender such as Chase.
Okay.
They-
And then FHA would be secondary, right?
Nope. FHA and VA are both primary as well. See, FHA and VA, neither one of those entities are the lenders directly.
Right.
So you'd have to go to a conventional lender such as Chase in order to get a loan under one of those categories. So far as everything makes sense. Let's talk about FHA. The key to FHA, yeah, let me change colors for a second. The key to FHA, and hopefully this color comes up, is that word right there. Insured. FHA is an insured product. The federal government doesn't lend the money. They simply act as an insurance company. They basically state this: Mr. Lender, you give this buyer a loan under these conditions, and we will insure you against loss. That loss is 100%. So if you get a $300,000 mortgage, you go into foreclosure, bank's got to take it into foreclosure, they got to sell it, they can only sell it for $250,000. There's a $50,000 loss there, correct?
Yes.
It's FHA, the federal government gives the bank that $50,000. So on an FHA loan, the bank is always kept whole. They don't lose money. But on top of it, when a home goes into foreclosure, who traditionally takes ownership of that property as a result of the foreclosure? The lender, not an FHA. HUD takes ownership. If you've ever seen HUD foreclosure lists in the paper, those are FHA loans that have gone bad. So look at the lender as a triple win. Do they get to keep all of the interest the consumer pays on the loan? Yes. Are they 100% protected by the federal government? Does the lender have to take ownership of the house? So they win on all three levels. They get all the profit, they get insurance from the federal government, and they don't have to take responsibility for the house. That's an FHA loan. VA, on the other hand, the key on VA is this word. I don't know if that's going right. Guaranteed. The VA is not an insurance program. The VA goes to the lender and says, Mr. Lender, you give this veteran this loan under these terms. We will guarantee you against any loss. On VA, the guarantee is 25%. 25%. There you go. Of the mortgage amount. So if the lender gives the veteran a $400,000 mortgage and they go bad, the VA comes walking in and say, Mr. Lender, there's a $400,000 loan. We'll guarantee you against losses up to $100,000.
Wow.
Now, for what?
The lender's taking it on the chin.
No, because traditionally, losses are far less than 25%. That's why they have it appraised, and that's why you buy it at appraised value.
Wait a minute, so you're saying if the house goes belly up, the lender gets 100,000?
The property has to be sold. Let's say you've got a mortgage of 400. It's sold for 350. VA will cover that 50,000. But you got a 400,000 on mortgage. It's sold for 275. The VA will only cover 100. The bank covers the rest. VA only covers 25%.
So the bank does take it on the chin.
They can,
They can.
but I don't know of a single case in all the years that I've been in business that's happened.
Can the bank go after the owner?
No, not in a VA.
So they just take the loss and write it
Yeah.
off?
All right, does this make sense? I wanted you to have a basic knowledge of the three loan packages that we tend to use. We're talking about qualifying for a loan. And what we're looking at is what portion of your income can we use to help you buy a home with. Now, I had drawn this out. Lost that slide. Okay. I said we're going to use 30% for taxes, and the remaining 70% is going to cover both long-term debt and your ability to live. So now the question is, where is this line going to be? Am I going to give you that much towards long-term debt? That much? This much? Well, the percentages of what you can use for long-term debt and housing are defined by the marketplace. And here are the current rates. Conventional loan, when it comes to your housing payment, that's your principal, interest, tax, and insurance, you can use up to 28% of your gross monthly income to cover your monthly mortgage. With regards to overall long-term debt that'll take more than 10 months to pay off, it ranges between 36 and 45. Now, when Edna comes in to visit, she's also going to tell you that lenders on a conventional level are getting a little bit more bold. In certain circumstances, they'll even take this up to 50%. So think about this for a moment. Let's assume you make $10,000 a month. That's your gross. 30% of that goes towards your withholdings. That's $3,000. How much is left over? $7,000. If the lender approves you for a 50% long-term debt ratio, is that going to be 50% of the 7 or 50% of the total 10? Total 10. So what's 50% of the total 10?
5.
5. So you got 5,000 for long-term debt. You got 3,000 for your withholdings, right? How much is left over?
2.
Can you put food on the table, gas in the car, pay the utility bills on $2,000 a month?
Depends.
If you're making 10,000, do you have maybe a little bit more that you want to put on the table? See, that's what you've got to think about as a practitioner.
So what is long-term debt? That's your obligation?
Those are debts that will take more than 10 months to pay off. And I'll give you a short list in a few moments. But this is what you've got to keep in mind, because when I come to you to buy a home, in order for you to earn a commission, you got to prove that the buyer you have presented to the seller meets 3 qualities. They're ready to buy, they're able to buy, and most important, they're ready to buy. But it's that able that I'm looking at. Do they have the financial resources to be able to afford the loan? Now, because FHA is backed by the federal government, FHA has established their parameters, so there's a little bit more latitude for you, the consumer. Conventional, 28 maximum housing. FHA, 33. Unless the property is a greenhouse, that means energy efficient, then they'll go to 33%. On VA, all they care about is long-term debt, bottom line. So just for the record, this 28% right here for housing, is that included in the 36 or on top of the 36? It's included. Your housing is considered to be long-term debt. For this course, all I'm going to ask you to do is remember the conventional ratios, more specifically the housing ratio of 28%, because I will be using that in various math problems when we start calculating how much a person can afford. But this housing ratio, this housing component, what does it consist of? Here is our standard today. Now, I'm going to draw a line right here. The top 4 are what's called the traditional PITI. Principal, interest, taxes, and insurance. Principal and interest. The type of loan that you are going to take out today is called an amortized loan. And basically what that means, it is a type of loan where every payment you make, part of that will go to the principal, so you pay off the debt, and part of that will go to the lender, the profit, the interest. That's a standard loan today. Now, property taxes. For those of you that own homes, do you pay property taxes?
Yes.
Excuse me, do you have to?
Yes.
If you don't, do they take your home away from you?
Yeah, eventually.
Okay. Well, you say eventually. What do you mean by eventually?
You gotta, yeah.
DuPage County, 2017. Property taxes in DuPage County are due June 1 and September 1. They're in 2 installments. That second installment of September 1, you have 30 days to make your payment. It's now October 1st. You've not made the payment. You're delinquent. You will receive an email, not an email, a letter from the county. You're delinquent in your taxes. Unless they are paid within the next 10 days, your property is subject to seizure and sale.
Wow.
2017. All tax sales for that year was completed on November 21st.
Man.
A month and a half after you were given notice you're delinquent. See, they don't play around. It used to be like January, February, but they're shutting it down. They need that money.
Man, it's crazy.
Now, which is going to have a greater claim on your property? The property taxes or your mortgage? Taxes? Yeah. The government always comes in first, which gives your lenders a little bit something to think about. What if you don't pay your property taxes? Will the home be sold? And what will it be sold for?
The debt.
The amount of the tax. Does that include the mortgage?
No,
Does that mean your lender now has bad debt?
no,
They lose it all?
no.
Yes. Because they sold your property for the tax bill. Not your mortgage.
Wait a minute, not the lender. The lender didn't sell your property.
No, the government did, so the lender loses.
Well, I don't think the lender loses.
They lose it.
They can come after the owner.
No, they can't. The lender loses. Because the house is sold to an investor. I didn't pay my taxes. Daryl buys my property taxes of $14,000. I got a mortgage with MB Financial. When Daryl gets that deed from the county, what does the MB get? Nothing. Can they come back after me? The answer I said was no, because today, 99% of home mortgages provide that the lender cannot go back after the borrower for any losses. So they can't come after me. Michael?
Wow.
So you buy a house with taxes. Does the person that is occupying that space have a certain amount of time to
Yeah.
repurchase the house back?
Yeah, there is a second chance. I'm going to talk about it when I deal with Chapter 10 and property taxes.
Couple of years.
Yeah, well, it also depends on the property, but yeah. For the most part, if it's a single-family home residential, they've got 2 years to redeem their property and keep it. But I'll deal with that in Chapter 10.
And if they made any improvements, they just lose that out.
They lose
just
that, yeah.
out.
So
Well,
then,
let me ask you this though. Go ahead.
so then what happens to the lender when they just lose? It's just like.
See, that's why I'm looking at this point right here. Because the lender has a chance of losing out. Most often, the lender is going to mandate that the buyer go on what is called a budget plan, where 1/12 of the annual tax bill will be collected with the monthly payment. So when the tax bill comes due, they've already got the money to pay for it, to prevent the government from coming after it. Have there been slip-ups with some lenders? Yeah, there has. But for the most part, the lender is going to make sure that bill gets paid so the government has no claim to the property.
So you're saying that if I own property, don't pay the taxes, the property can be sold out from under me, and I just get to walk away with no debt.
No obligation, yeah.
But if the property is foreclosed on, I can have a debt.
Possibly, but once again, most mortgages today are not providing for the lender's right to come after the consumer for that extra money. And I'll explain that again. That'll be in Chapter 15.
But will this make it harder to make a new purchase of a home? So
Oh,
they
you get
like.
Yeah. Yeah, anywhere from 2 to 7 years. Also, here's this next concept. There's a rule of thumb that we use in real estate when we talk about property. Property is comprised of 2 elements, the building and the land. And as a rule of thumb, we use an 80-20 threshold. 80% of a property's value is in the improvement, the building. 20% of the property's value is in the land. I'm going to buy my home. Let's assume I buy it for $400,000. That's the purchase price. The land is 20% of that. So the land will be $80,000. The improvement is 80%, and that's going to be $320,000. You agree with me so far? Now, let's assume that I go out tomorrow night and I'm having fun with some friends. I come home and there is a whole squad of fire trucks in front of my house. And they're dousing the remaining embers of what used to be my home, as it's totally burnt out. Nothing but a foundation and a vacant piece of land. And I'm looking at this thing and I realize I forgot to pay my homeowner's insurance, which means I have no fire insurance on the home. Is there an expectation that I will come up with $320,000 to rebuild the house out of my own pocket? Yes. Is there also a possibility that I might look at this and say, Mr. Lender, I can't do it. I don't have the money. Here are the keys to the non-existent lock. I'm turning the house and land over to you. And is that a possibility?
Or just walk away from it.
I'm going to walk away. That's a possibility, right? If I do that, and we're doing standard loan, which is 80-20, which I've got up there, how much has the lender got invested in my house? My land?
80.
No, 80% or $320,000, right?
Right.
What is the value of what remains after the fire has wiped out the house?
80,000.
Land, 80,000. So am I giving the bank vacant land that is now a guaranteed loss to the bank? Yeah. Therefore, wouldn't it be prudent on the lender to make sure I keep up my hazard insurance, my fire insurance? And if I don't keep it up, will they buy it for me but bill me for it?
Yes.
So what the lender is going to do is they're going to mandate as a part of my monthly payment, get rid of all that, 1/12 of the hazard insurance be collected each month. What I have right now, the traditional monthly mortgage payment consisted of these 4 items: the principal, the interest, 1/12 of the taxes, and 1/12 of the insurance. So the lender can have a sense of comfort that when the tax bill comes due, when the insurance bill comes due, there's money on file to pay for it. However, more and more properties are ending up in associations, not just condominiums or townhouses. We're getting homes, single-family homes in associations. Ginger Creek has an association.
Well, that's terrible.
What's the association for? For Ginger Creek, it's just to maintain the entryway, because they've got a brick entryway, they've got flowers, they've got trees, they've got lighting. Well, that's got to be maintained. So all the homeowners have to contribute to do that. Now, an association like that, it's an annual dues. But if you're living in a condominium, it's a monthly dues. Now, while the lender isn't going to pay your association fees for you, they want to make sure that you have enough income that you can cover them. If you don't pay the association dues, can the association put a lien against your home, your condo? Can they file a foreclosure? Yes, they can. And could that foreclosure take precedent over the lender? Say yes. So they want to make sure you make enough money to cover that monthly assessment fee, as they don't want to have this association upsetting the apple cart. Now, today, consumers don't want to put up 20%. They want to put up less. And if they do so, does that mean the bank's got to put up more money?
Sure.
Greater risk to the bank?
Sure.
On a conventional loan, does the lender have anyone they can turn to if there's a loss? Which is why they're going to mandate you take out an insurance policy called PMI, Private Mortgage Insurance. And that the lender wants to have some insurance. If you go bad and they have to, excuse me, sell it for less than what?
Purchase.
Well, what they've got involved in it. There's a loss there. The insurance company will pick up the loss. So anytime you put less than 20% down on a conventional loan, you will have private mortgage insurance. For the record, FHA also has private mortgage insurance, but it's called MIP, Mortgage Insurance Premium. VA loans does not have this type of insurance. I will restate all of that when we get into chapter 16. But what you see on your screen right now are the 6 elements that comprise the housing allowance. Does that make sense? All right, I've got just about 8:10. Why don't we take a break right now and come back then, and I'll finish off what I'm working on and continue working through chapter 3. Everybody online, I'm going to shut down the camera, the microphone for the next 10. We'll be right back.
How much they
All
want.
right. Back online. Does anybody have any questions?
Yes.
What?
When's the best time to be a real estate agent? In the
Right now.
In the seller's market or buyer's market?
Both.
I'll say too much.
It really depends upon what you're doing. But I've had success in both marketplaces. You just adjust how you approach the market and what you do.
Let me ask you this. Let's say it's a seller's market, and the seller gets 2 contracts for the appraisal. The seller can also initiate a bidding war, right?
Wait, repeat that again.
Seller's market.
Yeah?
Seller receives 2 contracts for the appraisal.
What do you mean appraisal?
The house is appraised at $200,000. 2 people offer $200,000.
Okay.
Can the seller create a bidding war?
What do you mean by creating a bidding war?
Well, I get 200 twice. I think if you want this property, you should pay more.
Okay. So,
Can that be done?
give me a little more insight on what you're talking about.
He's asking if.
No, I know what he's asking.
See,
I need clarification.
Here's my issue. I know a broker
Yeah?
who bought a home,
Yeah?
and the asking price was $230,000,
Okay?
and she offered $250,000, and I go, you shouldn't do that. Number one, you'll never have any equity in this property because you overpaid to begin with,
Okay?
but she did it anyway.
Okay?
Can the seller create a bidding war?
Now, are you asking, can the seller say 2 buyers? All right, guys, I want, rather than 200, I want 220. Is that what you're saying?
Yeah.
Wrong approach. That's what I wanted you to get into. What you're talking about is a buyer's tender an offer. Seller can counter and say, nope, I don't want 200, I want 220. But you never counter 2 offers simultaneously. Because in doing so, if both buyers accept that counter, you've sold the house twice. You're now going to court. So what I do is I say on behalf of the seller to these brokers, seller is rejecting both offers. Tomorrow night at 7 o'clock, bring your highest and best offer.
So that's how the seller creates a bidding war.
Yeah.
But let me ask you this. If the asking price was satisfied by the initial offer, how can the seller renege?
Because there's multiple points to an offer, not just the price. I don't like your closing date. I don't like the time you're going to get financing. I don't like the fact you've got 5 days to get a home inspection. See, that's what the price is never the final element. Most people think it is. But there's multiple components in the offer.
If they have a pre-approved mortgage and things like that. Someone's
Well-
Well, you can't make an offer if you're not pre-approved.
Yeah,
Right.
If you have two,
But you got pre-approval. Is there maybe something else in the offer I don't like?
Or that
Yeah.
you can find.
Well, I can find anything. I can find
That's
a
what I'm
reason to
saying.
cancel any
And that's
contract.
how so that's how the seller
Yeah.
creates a bidding
Yeah.
war. Okay. Okay.
Yeah.
Even though
I decide I don't want to leave you the
satisfied
the refrigerator. You want it? I don't want to leave it? That creates a counteroffer. All right, so let's move on. We've gotten through the 6 elements that create your housing allowance. But the second phase of this is long-term debt. And long-term debt by definition is any debt we incur that will take more than 10 months to pay off. Okay. All right. Long-term debt is any debt that will take more than 10 months to pay off. On my screen, I have a short list of what that might include. Your auto loans, student loans, credit cards. Now, credit cards, just for a rule of thumb, we take 5% of your outstanding credit card balance. That's the rule of thumb that we use. Personal loans, child support. If you owe child support and it's going to take more than 10 months to pay off, it's a long-term debt. We've got to count it. Federal tax liens and your housing. So this is what we look at as long-term debt. Now, I said this is a short list. There are other things I can add to it. But I just wanted to give you a heads up on what that may consist of.
So these are just a list of things that are considered when trying to figure out what your.
What you can qualify for.
Right, okay.
Does that make sense? So what I'd like to do is show you something. How does this directly impact the ability for you to purchase a home? So here's what we're looking at. I've got a couple, they make $117,000 a year. That translates into $97.50 per month. Their housing allowance on a conventional loan is 28%. That means they can have up to $2,730 in monthly mortgage payments. I'm using the traditional 36% threshold here for long-term debt. That means they've got $3,510 they can use for long-term debt. If this couple has no expenses at all, we have the ability to use the full $2,730 to cover their monthly housing payment. At 4.5% interest over 30 years, for 20% down, we can put that person into a $670,000 home. That's what it translates into. But this couple has expense. They've got 2 cars, both are financed, 478 and 512. They have a student loan outstanding of $274. They have $12,200 in credit card debt, which translates into $610 a month. So before they even walked into the lender's office, they already owed other creditors $1,874. Now, since your housing is a part of long-term debt, if they already owe $1,874, all they have left to purchase a home with is $1,636. 4.5% interest, 30 years, 20% down. Because of that debt, we're putting them into a $320,000 house. Because they wanted the cars, because they wanted to go to college, because they wanted the credit card, they just gave up half of their buying power. Pardon?
I'm just like, the student loans and stuff.
Yeah, this is where your job comes in. Because you're going to take this buyer out to look at homes. You've got to know where they stand. Now, it's often wise when you meet a buyer First, ask them, have you been pre-approved by a lender? If not, let's get that done. Because now it's in the hands of a lender to give you, the agent, direction what they can afford. Theoretically, we're supposed to be able to do this, but we're not financial people. Therefore, we may not have all of the little concepts that a lender is going to need to deal with in order to qualify a person for a loan. Does this make sense? Now, what I've got on the screen right now is not testable. It is merely to show you the impact that these debts have in your ability to purchase a home. Questions? All right. The next component that I want to address with you is on page 26. Tax benefits. The point with this next component is, why do I want to own real estate? What advantages do I get out of it? Well, to an investor, one of the key advantages of owning real estate is being able to reduce my tax exposure. And there are 6 areas I want you to be aware of for the state exam. The 3 that I have on the top, which I've encompassed, they're ongoing. You get these benefits every year. The 3 on the bottom occur either when you buy it or when you sell it. So I want to focus on the top 3 for a moment. Now, in this example, I have not converted this to be compliant with the new tax laws. As you're aware, the new tax law limits your property tax deductibility to $10,000. I haven't put that in there. So disregard the numbers I'm going to be using. Just think about the concept behind it. Because you're paying property taxes to another governmental entity, you are allowed to deduct monies from your income. Basically, reduce your tax exposure. When you borrow money, do you give the lender profit? Interest?
Sure.
Tax deductible. Now, on these 2 items, what I'm looking at, on these 2 items, what I look at, meaning the tax, property taxes, mortgage interest, are those deductions I can take on every piece of real estate that I own? Yes. It's not limited to 1 or 2 pieces of real estate. If I own 50 homes, I rent out 49, I live in 1, I can take the taxes and the interest off of my income taxes in all 50 homes. And that's what investors are looking for. Why did Inland buy Zurich Towers? Yes, it's got income, but it also has tax advantages. The property taxes are tax deductible. The interest on the mortgage is tax deductible. So that's an open picture. But now I got this term depreciation. Okay. Tiffany, what do you drive? No, what kind? What kind? How old?
2013.
Where is it likely going to be in 15 years? Likely?
Not in my driveway.
In the junkyard, right? So can I safely assume that everything man creates wears out?
Yeah.
And can I apply that same concept to buildings? Yeah. As buildings get older, they become less desirable because they may not have the features that society is looking for at this moment in time. And as that building gets older, are you technically losing money because it is getting older, less desirable, less useful? Is that a concept? Yes. Now, from a tax perspective, that loss of value because the building is getting older is a tax deductible item, depreciation. Depreciation is a tax deduction taken from the fact that the building getting older is going to be losing money every year. Now let me give you an example of what we're dealing with. Let's assume that I purchase a property for $1,200,000. With that property, what does it actually comprise? Literally, what is that property comprised of?
Building.
And land. So is the building and the land going to have a little piece of that value? What did I say the rule of thumb was the land portion?
20%.
So land is 20%, or how much in this case? What's 20% of this? $240,000. That means the improvement is going to be how much? $960. Does land depreciate? Does land wear out? No, it's indestructible. So when we talk about the nature of depreciation, we can only apply this concept to the improvement, which is why I separated the value of the land from the improvement. Because it's $960 is the only thing we can deal with. Now this is tax deductible. And I own this building. I want to get the greatest tax advantage out of this thing that I possibly can right now. Is anyone familiar with accounting procedures, depreciation? No? There are multiple ways that we can depreciate property. There are multiple ways we can depreciate property.
All at once, over time.
Well, that's what we have to look at. There is double declining balances, sum of the year's digits, macros. But the IRS only allows one method to be used when it comes to depreciation, and that's called straight line. That means you have the same amount of loss every year. Now that being said, I want to get the greatest depreciation I possibly can for tax benefits. So I make a decision that this property only has a 5-year life. At the end of 5 years, it'll be worn out. I'm going to have to tear it down. So if I divide this by 5, can somebody do the math for me? What does it amount to? I only make $100,000 a year. Am I going to pay any income taxes? No, because I've got $192,000 of loss. Put that against my $100,000 of income, I'm losing $92,000 a year, right? IRS is not happy with that. Therefore, the IRS is going to predetermine the time period you're allowed to use. Now, to give you an understanding of what I'm working with, there are 3 different age factors when I talk about real estate. When I use the term actual age, that's reflected of the number of years the building has actually existed. When I use the term effective age, that is the perceived age based upon the quality of condition. Now look at the building that we're in right now. You've only seen the lobby, the hallway, the deli, and the meeting center. And the level of quality, the level of condition that you see here is existing throughout the entire building. So based on what you've been exposed to, what do you think the age of this building is? Any thoughts?
50, 60 years.
50? 70? Does this building look like it's 70 years old?
I meant built in the 70s.
Oh, built in the 70s. That puts it about 48 years old. years old now. Okay. The normal age bracket I get is between 35 and 45 when I ask the question of students. But see, Chris, you caught me off guard when you said 70. Why? Because this building is 70 years old. Yeah. You were right. That's why you caught me off guard. So the actual age of the building is 70. The effective age is about 40, 45 years of age. That's the application of those two age brackets. Just remember, effective is always a perceived age, not a real age. Can I have a building that's 5 years old that looks like it's 30 years old? Yeah. This can go both ways, good and bad. But there's a third age bracket that we deal with. It's called economic life. Now, the building that we're in right now is an office building. It generates income. As an investor, do you have every right to expect this investment building to produce a return for you every year? But every year this building exists, it's getting older. Could that make it harder for it to produce an income? Pardon?
More repairs.
More repairs, exactly. Economic life, by definition, is that period of time that we can justifiably expect a financial return on the building. Economic life is that period of time that we can justifiably expect a return on the building. And that's the time frame we use to create depreciation. Because with depreciation, what we are expecting is that over time, the building is going to wear out to the point it's got to be torn down. It's like over time, Tiffany, your car, your vehicle is going to end up in a junkyard. It'll be scrap metal. It'll be worth nothing. The question is, what is that period of time we're going to use? A moment ago, I used 5 years. But the IRS doesn't like that because it really makes it difficult to collect tax from you. So the IRS, and when you're in practice, this is what you're going to use. They preset the minimum number of years that you can use for depreciation. If the building is residential in nature, and I'm not using this in the specific sense, but in the generic sense, any building where people reside, the IRS states the minimum number of years for depreciation is 27 and a half years. If it is non-residential, it's 39 years. So if it's an apartment building, we depreciate over 27 and a half. If it's an office building, over 39 years. Those are time factors preset by the IRS.
What's that?
Non-residential.
Oh, non-residential.
Non-residential.
Oh, so it could be what? Commercial?
Office, retail, industrial.
I do have a question.
Yeah.
So you said that's kind of like a fixed number. So say, for instance, I think yesterday you described like there's just a vacant land, nothing there. There isn't really a town or anything booming. But someone comes in and start to build like a community or whatever. Does the land price go up then?
Usually it will appreciate, yes.
Okay.
Yeah. In this concept, though, appreciation is not a factor we consider. We're only looking at loss of value because it's getting old.
Okay.
That's it. So let's assume this is an apartment building. I'll divide my 960,000 by 27.5. What is my annual depreciation going to be?
$34,909.
Agreed?
Yeah.
I make $100,000. Am I still going to pay income tax? Yeah.
David,
Yes.
do they like if you make any improvements, whether that like foundational improvements improvements or anything to the property, do they reduce the amount of years that it depreciates?
No. Everything here is fixed and it's always based upon the value at the time of purchase. It does not take into account appreciation, does not take into account improvements. Everything's based upon what it was when you bought it. Do you understand what I'm doing right here? Do you have even if it's just slight understanding of depreciation and its impact? This is why investors want to buy the building, because they got $34,000 worth of depreciation they can declare each year. Any questions? Yeah.
If this is a commercial building, why would you use 39 instead of 27.5?
Because I said it was an apartment building. And 27.5 is for apartment buildings. 39 is for office and retail.
Now, is that the apartment building with 4 units or greater than 4 units?
No, this is in generic sense. So it could be any number of units.
People are living in there.
Right.
But I thought you said that any residence of over 4 units is commercial and not residential.
It is.
So how can you use a residential figure against a commercial property?
The IRS set this up simply on the premise that if the building is where people reside, it's residential. Yeah. That's why I said generic sense,
Okay.
not specific. Does this make some sense? All right. Then go back here. I'm looking at the first 3 items. Your property taxes are tax deductible. Your mortgage interest is tax deductible. Now depreciation. You can only depreciate investment real estate, not your primary residence. You cannot take depreciation in your primary residence. Own an apartment building, a 2-flat or a 200-unit building is a material. You can depreciate that. Own an office building, you can depreciate that. The home that you and your family just moved into, you cannot depreciate.
What about a second home that you rent out?
Then it's investment property.
But if it's just a second home, like a vacation home?
Then you can't.
Wow.
So let me show you the application and how we define this. Michael?
Okay, so one, is it true that to like kind of lower your monthly payment, you can dispute your taxes every year, do your tax bill?
You can file a tax appeal, yes.
Okay, so say you do that, right?
Mhm.
Because you're just being savvy. And they approve it. So you file your appeal and you get it, then you're paying less property tax. Can you use that extra like bank that was originally going to property tax that is not any longer for like mortgage interest or appreciation?
It has nothing to do with it. You're talking about property taxes.
Then you say $10,000 a year.
Correct,
So I'm saying if you say your tax bill is $8,000 a year,
correct.
you got it down like miraculously $6,000.
Hmm.
The extra $2,000, can you use that off in other subjects?
No, it's lost.
Those are.
Yeah, because it's different concepts and the IRS will not allow for that. So here's the situation. Let's assume I own a 6-unit apartment building. Units A and B are renting out for $11.20 each. C and D, $1,300 each. E and F, $1,200 each. That means each month I'm bringing in $72.40 in rent. This is gross rent. That translates into $86,880 for the year. I bought the building for $830,000. I put 20% down, which means I'm going to finance 80%, which is $664. I'm going to use the threshold of 80-20 for land to improvement. And since depreciation can only be on the improvement, that's also $664. So what are my tax benefits? First of all, my property taxes. Like I said, I did not put this under the new schedule, so just accept what I've got. Property taxes in DuPage County. The rule of thumb that I use for property taxes is 2.75% of market value. So if your home is worth $400,000, 2.75% is approximately what your tax bill is going to be. Cook County, I use 3.8 or 3.9, simply because of the way they do their taxing structure. So let's say this is DuPage County, 2.75% times the market value of $830 means my property tax bill is $22,000. This is why there was such a big uproar with this new tax structure, because the new tax structure limits that to $10,000. So that's $12,000 of tax deductibility you had last year, you do not have this year. People are upset, especially these investors. Because this is an investment building, lenders typically want a little higher interest rate because there's more risk involved, as I don't live there. So they're charging me 5.65%. When I quote you an interest rate, is it per week, per day, per month, per year? Is the interest rate per week, per day, per month, per year?
Year.
Per year. So if I take the mortgage amount of $664 times 5.65, my interest is $37,000 a year. This they did not touch. So you still get to take the full amount of your annual interest as a tax deduction. Now, breaking away for a moment, is it possible for me to buy a home worth $830,000? Can I buy a home at that value?
Yeah.
Sure. And as a homeowner living in the home, can I take both of these off as tax deductions?
Sure.
Yeah, exactly. So whether you live in the home or you have it as an investment product, you have tax deductibility. This is why they tell you buy a house, buy a condo. It gives you some protection, some tax benefits is what I'm looking for. Okay. But this is not a house. This is an investment building, which means I can take depreciation. Now, a moment ago, I gave you the 27.5 and the 39 as thresholds. Those are the thresholds in real life. On the state exam, use whatever economic life the question provides for you. That's why I chose to give you an economic life of 30 years. So I'm going to take the 664, which is the value of the building, the improvement, divide that by 30 years. How much depreciation do I get to claim each year? Well, the answer is going to be $22,133. But here's something else I want you to realize. I need that space. Let me get rid of that. This $22,825. Did I actually write a check for that? Did I actually write a check to the county? Say, here's my property taxes? Yeah. Because I had to pay that money. The interest was $37,000. Did I write a check for that?
Sure.
Yeah, I did give that to the bank, right?
That's your payment.
So the $22,000 depreciation, do I write a check for that?
No,
Why not?
because that's what you're gonna deduct.
So where's that money? If I'm not paying that money out, where is that money?
Your pocket?
Exactly. It's in your pocket. Depreciation is a paper loss. It's not an actual dollar loss. Now, if I add those three numbers together, that comes up to $82,476. I made how much money on this property this year? I made $86,000. I've got $82,000 in losses. What do I declare to the IRS as income? $4,000. Did I really lose $82,000?
Wait a minute. How'd you get 4,000 again?
86,000, my income, minus my deductions, 82,000. So I'll pay income tax on $4,000.
Wow.
But did I really lose?
No.
I still have $22,000 sitting in my pocket that I can use to go on vacation with, I can go buy a car with. I'm telling the government I lost that money because my building got older. How can I pay income tax on something that I lose? But it's not a real loss. That's why they call it a paper loss. What I just went through is not testable information, but it's a concept behind it that I need you to be familiar with. Why does an investor want to buy real estate? Because they get deductions they cannot get anyplace else. Why do investors oftentimes like to buy multiple properties? Because they get these deductions on every parcel that they acquire. So is it possible that you can acquire enough buildings to get enough depreciation or enough deductions so you end up paying no income taxes and yet still have money in your pocket?
Sure.
Yeah. It's how you work the system. Does that make sense? All right. So let me go back here. So we've taken a look at the three top ones. And at this point, it's more important that you understand why they are tax deductible, on what kind of property they are tax deductible, than actually how to come up with the numbers. The three on the bottom. I said these are tax deductible, but either at the time you buy it or at the time you sell it. Earlier this evening, I asked a question and I clarified a point. Who gives the mortgage? The borrower or the lender?
Borrower.
The borrower. So in theory, if I am looking to borrow money from a bank and I go into Chase, hey guys, I want to borrow money from you to buy this house. If you give me that mortgage, I'll phrase that, if you give me the money, I will give you the mortgage. I'll let you use the property as the collateral. That's the theory, correct? So if that's a true statement, shouldn't I be handing to the bank that piece of paper that says, I, Dave McGowan, allow you to use the property as the collateral? Shouldn't I be giving them this piece of paper? But I don't. Who does the piece of paper? The bank. They're going to do all the documentation to process the loan on your behalf. And they do such because there's going to be provisions. Tiffany, you got a house? Do you ever have to put a roof on a house? Did you? Twice. Did you call the bank and ask for permission?
No.
Should you have?
No.
Yes.
Oh, really?
In every mortgage contract, there is a provision that before you make any major improvements to the property, you call the lender and ask for permission. Because there's a specific type of lien that could be placed on your home by the contractor that could jeopardize the lender's position. You know it.
Yeah, but that's why we asked for a waiver.
Right, but we still have to, this is what the contract dictates. You never did ask, right?
I guess we should have asked them for the second story addition on my house then too.
Yeah. But the realities are, while it's a provision in the contract, we typically don't do it. We just go ahead and make the repairs. Like I'm putting a fence on the house right now. I didn't ask the lender for permission.
But you're talking two different things. You're talking maintenance as opposed to improvement.
Doesn't matter. If I hire a contract to do the work, no matter what the work is, they have a right to put a lien on my home that jeopardizes my lender.
Right. But what I'm saying though, if you repair a roof, it's not an improvement.
Doesn't matter.
Okay.
Does a contractor have a right to put a lien?
Sure.
Yes. That's why you gotta let the lender know I'm doing it, so they are prepared.
Okay, Dave, can you give me just a full understanding of what a lien, exactly what a lien is?
Go to page 172. Michael,
What if you do the work yourself?
Oh, that's different.
nope, because there could also be a lien based upon the supplies that you buy.
Oh, if you use
So-
a credit card?
You go to any,
If you pay cash, there's no possible way.
well, if you pay cash, there's no, but if you use a credit card, you finance it, they have a right to put in there. You look on page 172, first paragraph, first sentence. Would you do me a favor, please, and read it aloud for us?
Sure. A lien is a charge or claim against property that is made to enforce the payment of money.
That's it. A lien is a statement placed on your title that says you owe me money. You have a house?
No.
Yes, you do.
I live in a house.
You have a house,
Okay.
okay?
For this conversation.
This weekend, it's my weekend to pay bills. And what I would like you to do for me is give me $10,000. Will you do that?
Sure.
Seriously?
Yeah,
You're right.
for
If you're serious, I'll take the money.
you.
But are you serious?
No.
Yeah.
You would give it to me?
What do you want me to say, David?
No, what would you do? If I came up to you just at random and says, give me $10,000, what are you going to say?
I'm gonna ask you why.
I want to pay my bills.
Well, I have bills too, David.
I don't care about your bills. I want to pay mine. Will you give me $10,000?
No, probably not.
Now, in real estate, a no is only a maybe. So I'm going to ask again. Would you please give me $10,000?
Maybe.
No?
No.
Either yes or no.
No.
All right, 2 no's never makes a no. I'm asking kindly, would you give me $10,000? 3 no's is a no. Okay. Now I've got a no. Forgive me your first name.
Chanel.
Chanel. Okay. So Chanel's got a house. Can I go file a lien against Chanel's house? Yes, I can. I do not need a reason to file a lien against your property. I only need $29 because that's what it'll cost me. And now I put a lien against Chanel's house.
Because I didn't give you to.
Exactly. You embarrassed me. So I want my $10,000. Either you're going to give it to me now or give it to me when you sell the house. But I want my money. The point I'm driving at, the definition of a lien is simply that we're using the property as the collateral for the debt. You owe somebody some money. We're using the house as that collateral. Anyone can file a lien for any reason at all. We don't have, the only time I need a real reason for it is if I want to take it to court and enforce it. See, a judge is going to throw my lien out.
Yeah.
It's ridiculous. But if you go to sell that home, you cannot sell it until you pay me off.
Or satisfy the lien.
That's paying me off.
Or take you to court.
But then she may
And
lose
have
the
it.
sale and get sued by the buyer.
I'm still confused. Well, what I mean, so what does that do for the bank? Like, how you need to ask permission? And then-
Oh, because a contractor has special privileges in the state of Illinois.
Mhm.
That if you don't pay the contractor for work they do on your home,
Mhm.
they can file a lien that could create a problem for your lender. As a result, the lender wants to know when you're doing work to the home so that they can be prepared in case this should happen. Now, I don't want to get too deep into it because I'll talk about it in chapter 10. However, I lost track of where I was at. Oh, we're talking about the documentation. Why does a lender do the documentation on your behalf? Because they want to ensure there are provisions in that document that you and I, as the creators, might not put in there. So they're going to do it. Does a lender ever do anything for free?
No.
As a result, they're going to charge you a fee. You want us to do the paperwork for you? No problem. It's going to cost you $3,000. Loan origination fee. It's the fee charged by the lender to process the loan, to put together the documentation you, the borrower, should be doing. Now, there are 2 ways lenders charge origination fees. The more common method for the last 2 decades has been a flat number, $2,000, $3,000, $4,000, payable at the closing. But an older method, which I found a few lenders starting to go back to, is called service points, meaning the fee is a percentage of the mortgage amount. My first townhouse, They were charging service points. I financed $120,000. The lender charged me 7 points. Now, 1 point is equal to 1% of the mortgage amount. Therefore, if they charged me 7 points, they wanted 7%. What was 7% of $120,000? $8,400. Just to have them type up the document allowing me to borrow the money. I've run across a few lenders lately that are starting to do the exact same thing. So you want to be aware of it.
So 1 point is equal to how much?
1% of the mortgage amount. This is a form of interest. Your loan origination fees is a form of interest which makes it tax deductible in the year you purchase the home.
But I guess if you don't like it, you can always go somewhere else.
Yeah,
Or you can shop around and get cheaper.
correct. All right, I neglected to take attendance, so I'm going to do that right now. Okay, Marissa, you're online. Shai, you're here? Could you talk to me after class? Thanks. Tiffany's here. Chris is here. Malcolm, you're here. Daryl is here. Chastity, I'm back. Gotcha. Michael, you're back there. Allie's here. Krista's here. Ryan, you're here. Beth is here. Everybody's covered. Good. Okay. Prepayment penalties. Please pull out your calculators. You got to do some math for me. Yeah. I didn't add you to my list, but I know you're here. Okay. Actually, I did add you to the list, but it's a little further down on the list. I just realized that. All right. Mathematics. I want to use today's numbers. I want to show you something. Let's assume that I'm going to go out and buy a $400,000 home. And I'm going to bring up a screen so I can write it out for you. So PP stands for purchase price, $400,000. I'm going to put down, DN just stands for down, 15%. How much am I going to put down? $60,000. What is my loan to value? What's the percentage for the loan to value? No. 85. Remember, loan to value is the percent of purchase price provided by the lender. I'm putting up 15. That means I expect the bank to give me 85%. How much am I going to borrow from the bank? $340,000. Agreed? Today's interest rate is 4.75%. Is that per week, per day, per month, per year? Per year. So if I multiply my mortgage amount by 4.75%, that's going to tell me how much profit the bank can expect to get out of me each year. How much is that? How long is a typical home mortgage written for? 30 years. Multiply that by 30. All right. When I sat down with the lender and I borrowed the money, I signed a piece of paper, the mortgage contract. And by signing that piece of paper, did I technically promise the lender that over the course of the next 30 years, I will give them $484,000 in profit? Yes. But what is the average time duration a person spends in a home today?
5 to 7 years.
Exactly, 5 to 7. So let's say I'm there 5 years. If it's $16,150 per year times 5 years, how much profit will I have given the lender before I decide to sell the house? It was 80750, right? Okay. Is that far less than what I originally promised the bank? So by my selling the home, am I technically stealing money from the bank? Money that I had personally promised they would get out of me? I promised them that money. I even went on paper and wrote out that I would pay this to you. Now I'm denying you that money. Think the bank's going to be happy with me? They had a chance to make $484,000 in profit. I've given them only $80,000 in profit. Can a bank penalize me for paying the loan off early? Yes. Please go to page 285 in your book, 285. We're in chapter 15, finance. Prepayment down at the bottom of the page, actually middle of the page. A lender has the right to expect to get this profit out of you. But if you elect to pay the loan off early, you are literally denying the lender the profit you originally promised them. The question is, does a lender have the right to penalize you because you paid the loan off early? Well, the paragraph that I want you to highlight is the very last paragraph of the page. And that paragraph reads, lenders in Illinois are prohibited from charging a borrower a prepayment penalty on a fixed rate loan secured by residential real estate when the loan's interest rate is greater than 8%. This provision of law was enacted when interest rates were 9, 10, 12% interest. Now we're looking at 4.5%, 4.75%. Does a lender have a legal right to charge you a penalty because you've denied them the profit to which they are entitled? Yes, they do.
Maybe it's not higher than it is.
Pardon?
Because it's not greater than it is.
Right. Now, the point I'm driving at is if you pay the loan off early, the bank has a right to charge a penalty. Today's marketplace, most lenders on residential loans don't do it, but they have a right. And if they do it, that is considered to be a form of interest payment. It's tax deductible. Let's go back to that screen. Prepayment penalties are tax deductible. Tiffany. Oh, you're about to do something. How long ago did you buy your house?
It's about 22.
Do you remember what you paid for it?
Oh, goodness. Something like, I don't know.
Make up a number.
I'm gonna say about somewhere around. Something 200.
All right, $200,000 is what Tiffany paid for it. 22 years later, she wants to sell it. That home is probably worth right now about $1 million.
Oh, please.
Did Tiffany make a profit on the sale of her home? How much? You bought it for $200,000, we sold it for $1 million. What's the profit?
$800.
Is that profit taxable income? Say yes.
Yes.
It is. Exactly. And that's what we're looking at. Capital gains is defined as the profit you earn from the sale of your property. Now, when I look at capital gains, there are two ways we must address it. Capital gains when it is your primary residence, and capital gains when it is an investment. Now, I'm about to go a little deeper than what your book provides, just because you do need to know it. Now, Tiffany, do you live in this home? And have you lived there for the last 22 years?
Yes.
Okay. When it comes to owner-occupied properties, your primary dwelling, the IRS is going to give you a special benefit when it comes to capital gains. But there is a condition, and it's a simple one, that you've lived in the property for 2 of the last 5 years. So have you met that requirement?
Easy.
Easy. And because Tiffany has met the requirement, are you legally married?
Yes.
Are you both on title?
Yes.
Good. Because she has met that 2-year requirement, Tiffany can take up to $500,000 of her profit as tax-free. So if she sold it for $1 million, made $800,000, she's only going to pay income tax on $300,000. The rest of it is tax-free. But Allie, are you married?
No.
And when Allie sells her property, she'll be limited to $250,000. So a single owner, that's why I asked if you were both on title. Because if you were the only one on title, you would be limited to $250,000, even though you're legally married.
I asked you, it's joint to the entirety.
It is.
It is.
Good. So you got the proper one.
Yeah.
Okay. So this is the limitation. This is the protection you have when it comes to capital gains on your primary residence. It's tax-free income. Does that make sense? Then I want to leave you this evening with one other example. And I'll pick up with this tomorrow afternoon at 1 o'clock. By the way, again, for everybody, we are on at 1 o'clock tomorrow, not 6 o'clock. I've actually had students show up here at 6 o'clock on a Saturday night because I have a morning class from 9 until 12:30. I know.
But it allows you to run errands in the morning.
We're gonna have green beer on
St. Patrick's Day.
next week.
But all the parades are this weekend.
No. Because I'm the Wizard Green on this.
Well, Chicago's is on St. Patty's Day. But a lot of the communities around here is on this weekend. Okay, example. How do we calculate and how do we define what your capital gains exposure might be? Let's assume I bought a home for $330,000. I'm now selling it for $682,000. The difference is my capital gain, $352,000. Now I'm single. Am I going to pay property or income tax?
Yes.
Yes, because I'm limited to $250,000. So I've got $102,000 of income that'll be treated as ordinary income and I'll pay income tax on. But I do have an aversion of paying any kind of tax. As a result, there's a couple of ways I can offset that. When you own the home, if you put any money back into the home as an improvement, for example, I put a partial roof on the house, refinished the basement for $22,000, a new kitchen for $28,000, partial exterior siding of $18,000. In the years that I've lived in the home, I've actually put another $76,000 into it. But I'm not done yet.
You have to show proof of receipts.
Yes. Yeah. I'm not done. I've got expenses to sell it. Do I have a broker that I have to pay? They want 6%. So based on $682,000, I've got to give my broker $40,000 in commission. Will there be other expenses I'm going to incur in order to sell my home?
Sure.
I'm simply taking 2.75%. That's another $18,000. So that's $59,600 I've got in expenses to sell my home. Well, the ruling is I've got profit of $352,000. I can deduct from that profit my capital improvements, all of the monies I put into the house. I can deduct from that profit the cost of sale. That reduces my capital gain down to $216,000. How much am I going to pay in income tax? $0. That's the benefit you have on your residence when it comes to capital gain.
So that number 2.75 is closing costs?
Yeah, I'm just using it as a round number. Does it make sense to everybody? Does anybody have any questions? Are there any questions online? Daryl?
Somebody, snookered me, because when I sold the house, I think I made like 15,000. And they said I had to reinvest that in order,
How long ago?
97, that was,
And was it a home that you lived in?
yeah. 21 years ago.
And how many years had you lived in the home?
Oh, let's see. Maybe 10 years.
Then they took advantage of you because it was back in the 70s when the federal government on primary residence eliminated the obligation to buy a new home.
I could have just put a lot of, I could have put all that money in my pocket.
That's right.
Yeah.
All right, does anybody have any questions? Are we all good? Is everything making sense to you? Okay, for the most part, huh?
I do appreciate when you tell us that it's testable, so like you can.
Yeah.
I'll throw it up there. Because-
Yeah, I want to make sure that we focus what you need to put your attention on as much as possible.
I just don't want to whatever, assume the questions and stuff that isn't really testable. But
Right.
when it's testable, I want to.
Good.
Yeah, I'm writing here, I'm over here writing everything down that everybody says. Everybody has homes that they owned and I've never even rented, so I'm just writing everything down.
All right, everyone, have a wonderful evening. I'll see all of you back here tomorrow at 1 o'clock.
Uploading these videos or?
I generally don't. That's why I'm recording.
Oh, okay. Will they be available?
They'll be available once I get the recordings converted to MP4 players. Let me stop the recording right now.